All right, so our top story. It's a big week for stocks, of course, as Wall Street tries to rebound from a rocky week. And we're getting a mixed message from major players on Wall Street. Goldman Sachs has upgraded its view on stocks, while JP Morgan, well, they are saying the opposite. And Julie, also a big week for economic data. But hold on, let's start on these notes here. JP Morgan really sounding the alarm bell, essentially saying to investors, you know what, all these gains we've seen in the first quarter, well, that's as good as it's going to get. We are concerned about valuations. We're concerned about sticky inflation. And we are, of course, concerned about what big companies are telling people about the economic slowdown.
Yeah, definitely. That's what we're going to talk much more about that in the morning brief in just a little bit. But it seems like after that down week that we had last week, the first of the year, it seems like now a lot of strategists are sort of taking a step back and saying, okay, not so fast here. Let's not get carried away. Mike Wilson, one of those folks indeed who is out with that, who said the equity market is refusing to accept the reality that the Fed might remain restrictive for longer than anticipated. And that seems to be sort of a growing chorus that we are hearing from strategists.
Yeah, just diving into this JP Morgan note, they're actually recommending investors reduce beta. Now, it's just a lot of fancy talk, really essentially means cut your exposure to stocks, and most notably tech stocks. Of course, tech stocks have really rallied out of here, out of the gate. You've seen falling bond yields on this view, and maybe the Fed is not out there continually to aggressively raise interest rates throughout the year, so tech stocks have benefited from that. But JP Morgan also noting a consumer spending slowdown, which was pretty interesting as well, saying consumers may have exhausted all their savings and they just have nothing else, no other money to out and spend this spring.
And something else, speaking of where investors are putting their money, according to some data pulled by the Journal from Refinitiv Lipper, investors have pulled $31 billion from U.S. equity mutual funds and ETFs in the past 6 weeks. So even though we have been seeing stocks go up in aggregate, we have been seeing U.S. equity funds see outflows. Where are they putting their money? They're putting it into fixed income, which is no surprise, given what we've been hearing from investors, and also international equity funds. So that's what's been attracting the money thus far this year. So it's interesting here that, mostly we're talking about equity investors here, or money managed on behalf of equity investors, if you're talking mutual funds and ETFs. So it's interesting that they are a little more cautious.
And of course, look, I mean, I think it was JP Morgan or another note I saw this morning, maybe Berenberg. The market, the S&P 500 is up 14% off those October lows. That is a huge move considering where corporate America is. And then I can't say I'm surprised by these notes, just given what we've seen in AI stocks, a lot of these fear of missing out, FOMO rallies starting to permeate the broader market. Of course, you're going to have these folks, a lot of these Wall Streeters come out here and try to be heroes and say, you know what, the top is in for the year. You know what, maybe we don't see these gains continue into the back half.
Yes, we'll see, though.